Thank you very much. So it's definitely the afternoon session as the hall is thinning out almost as quickly as my hairline, maybe possibly even quicker. It's great to be back, especially as apparently I was here last year. I must have said something. I think there's a slide I've been asked to put up, which I'll put up again. I think that's why. It's been a fantastic week in Cape Town. Table Mountain has been at its absolute best. I think you'd agree. And here we are. If it weren't for the chairs, I'd feel a little bit like I was in one of those Harry Potter postcards, which you're actually moving around. Something to send to the kids. So we haven't got much time, so I don't know why I'm rabbiting on. But today, there's a bit of a scoop. I want to show you two data sets that are unique and exclusive. They've never been seen before in public. That's just to whet your appetite. And I'm also going to talk about JSE dual listing and whether flow is moving offshore or not, because that is obviously a key topic of discussion. And hopefully there we've got some really interesting things to say as well. So this is my Where's Wally chart. Don't worry too much about whether you can see the labels or not. The overall impression is what I'm hoping for, which is one of complexity, and actually this isn't that complex. We can make it a lot more complex, and that's the background to our talk about equity market dynamics. I think of the dynamics as the why and the how the markets are moving. I think of the market mechanics as the where the market is moving. What we see here is every liquidity pool on 5 continents, from ASX all the way through to the US, where the top 15 dual-listed South African securities are traded. Each one of these bubbles represents a separately definable, distinct liquidity pool. The colors represent the type of liquidity pool. So, for example, the red is if you like, the order book, the intraday order book, where the price formation process is most important. The orange is dark pools, and the blue is the auctions. So the red, the orange, and the blue is effectively electronic trading. It's very easy to identify. Although it's in so many different places, we have to aggregate, consolidate, long before we even get a chance to analyze. All of the other colors, the yellow, the green, and the purple, are reported trades. So they're away from the order book. They're not contributing directly to the price formation process, but they are considered to be liquidity. And there's a lot of double counting, and there's a lot of noise. So when we look at the equity market structure, we have to digest all of this and decide what is really going into the price formation process. From that price formation process, how do we discover price and then act on it? And this is a very, very complex beast. We look at it all day long on our terminals. The algos are listening to this noise. And I've got 136 distinct sources of liquidity across 15 dual listed, and this is for the month of January. If we expand that to the full 439 dual listings in South Africa, it gets even more complicated. It multiplies. 136 times 15 times 30. That's roughly times about 21. That's roughly the number of data points that we're looking at, just to understand how much has been traded. So what I want to do today is to, in the context of that very, very complicated, if you like, market feed of data from the market mechanics, all the different places that we trade and how we trade, how do we aggregate that data to make it more visible, and how can we analyze it in order to understand liquidity, where liquidity is and in which direction it is moving over a period of time. And we're going to look at 3 different data sets. The last 2 are new. I don't know if you spotted the bullet point. The second bullet point says digger deeper into liquidity. This is what happens if you ask Chat GPT to draw your slides for you, and then you don't remember to. I think I might have said dig a little deeper into liquidity. I promise not to mention AI anymore. I might mention machine learning. So we're going to look into one way of looking at liquidity, which is through order book imbalance. And then finally, we're going to look at something that sounds really cool. Actually, it is, if you're geeky like me. And that's market crowding, which is, in essence, whether we're looking at liquidity that's being formed around a market with many participants competing on price and liquidity, or whether it's liquidity that's being formed around a small number of players who are potentially moving the market. That's what we're going to look at in the context of dynamics. So let's start, and I've got a lot of slides and 15 minutes to go. So imagine that this is on a screen, and then actually it is in the Trade Explorer, the JSE's Trade Explorer. All of these data sets are taken from the Trade Explorer that I'm showing you today. And we can see that in the biggest perimeter, looking at these dual lists, this is all the dual listed, not just the top 15. We can see that of an overall sort of 3 years and 2 months period, the traded value hovers around about the $5 billion per day. That's for all trading in the Americas, which is mostly ADRs, in APAC, which, by the way, is mostly BHP, in Europe, and in South Africa. We can see that South African market share is relatively stable at around about 25%, give or take. But this is noisy. It's noisy because of all of those off-market prints, all of those trade reports that are going back and forth outside of the electronic venues. If you think about the following case, imagine that a US investor sends an order to a London desk to trade in South Africa. It might be part of a program, a global program, for example. The London desk then sends that order to a South African broker to execute. It gets executed. We can now count that trade, a buy or a seller, very clearly. If it's executed on the order book, we know exactly how much volume has gone through. But what's going to happen then is the South African broker is going to book an OTC trade back to the London broker, who's going to then book another trade back to the US investor in order to get the shares back into the right depot, blah, blah, blah. So that trade has actually been counted 3 times. So that's where all the noise comes in. What I like to do, especially if we're looking at a trend as opposed to the absolute value, if we're looking at trend, let's take away all of that noise, all that off-order book stuff, and just look at electronic trading only. That changes the picture. We can see first off that approximately halves the average daily value traded, but we also see that it really normalizes over the period of 3 and a bit years, and we can see that actually South African market share is nearer the 40 mark. So I've excluded ADRs, which significantly reduces the US input to this. But ADRs are not necessarily traded in the same way, so I remove it from my proxy. We can add it back in. It doesn't really make that much difference. If we go a step further and we exclude BHP, PRX, and AHI, we more or less, we take, how much was it? We take more or less half again away from the daily value traded. And now we see a very different picture. We can see 22 was a huge year. There was everywhere. It was bigger than 23. It was bigger than 24. A lot of volatility in the markets. That drives the volume. But we can see from 23 to 24 to 25, we see the overall share of dual-listed securities, excluding these 3, the overall traded value goes up in a fairly linear way, and the South African market share is pretty stable. So when we strip away all of that noise, what we see in aggregate, once we've taken away all those liquidity pools and we've summarized them all together and we've categorized them so that we don't want to listen to the noisy ones, we get a much clearer picture of South African trading. And I think for me, this is the day-to-day relative value traded between South Africa and trading in the rest of the world in the dual-listed securities. If we only look at ISINs, ZA ISINs, it's around about 98%. And one final picture of this is the closing auctions. So the closing auctions is perhaps the purest liquidity pool to look at. It's been growing. We see that throughout the years. That's a trend that's well over a decade old, driven by passive trading, driven by ETF trading. And so we can see the closing auctions and the South African participation in that is getting now close to 45%. So that's South Africa, the dual listed. I know it's a big theme. Whenever I come here, that's what we're looking at. And I think this way is a good way to identify the trend and really and be able to monitor it. Now we're going to start to look at that second data set. And this is new. You won't have seen this before. This comes directly and exclusively from the JSE. It's taken from the JSE's order book. What we're looking at is order book imbalance. That's nothing new. Order book imbalance, particularly on an intraday basis, is a significant indicator. It's used very often within algos to determine the short-term direction of a stock, whether it's going up or down, whether you should cross the spread, or whether you should stay passive. What we're able to do by using order book data is to add an extra dimension. And what we're doing here is we're using the dimension of agency versus principal trading. I'm going to show you the data in a second. Buys versus sells, they always equal each other. That's kind of obvious. You've got a buyer and a seller. If they don't, then there's a serious problem, and we'd be looking at a different slide. But what is interesting is the proportion of agency trading versus principal trading on each side of the book. That's a different way of looking at order book imbalance. It's not a perfect science. We can imagine that agency trading is long only. It's also brokers acting on behalf of long short, equity market neutral, hedge funds and many other different trading styles. And of course, given that they're different trading styles and sometimes short, you can have agency traders on the buy side and the sell side. There are many different reasons why agency trading would be taking place on both sides of the book. For example, a long-only fund manager might be onboarding money, nothing to do with a change in price. On the other hand, a relative value fund might be shorting, a hedge fund might be managing their delta. So agency traders provide liquidity to each other. It's not digital on one side or the other. What's interesting is to look at the imbalance and how that imbalance moves from day to day. So the principal trading, there can be investors in that as well, particularly if they're trading on swap, for example, with a prime broker. So it's not an exact science, but as we look at the data, as you'll see here, everybody lean forward to gaze at these heat maps. What we can see is that the general picture tells us a lot of information. So what we've done is the top half of the slide. This is a screenshot from the pre-production version of this data set for Trade Explorer. What we've done is we put all the agency trading on the top and we put all the principal trading on the bottom. I forgot to ask you on the Where's Wally slide whether you'd seen or spotted Wally. What we're looking for is Wally, and I think we might have found him. So, and there's a giveaway because I've marked that in green. CPI, Capitec. So we're looking at the bank sector for the 7th of February. Don't worry about the color. I'm going to come on to the color in a second. I don't know whether that makes you feel more excited or less excited. But look at the size of the block. We can see that on the buy side of the order book, it's driven by CPI. We can see there's an imbalance between, on the agency, in the agency category, between the buy side of the book and the sell side of the book, and that imbalance is 11%. If we look at the principal side, there's also an imbalance, and what we can see here is if you look at the value traded in the banks on the buy side, it's 1.9 billion, versus the value traded on the sell side by the principals, it's 2.1. So we can see that the principals are providing liquidity. They're effectively making up the difference in the imbalance to the agents. So we've immediately got a view here that somewhere on the buy side of the book, especially in CPI because that's where it's being driven, there's buying activity. Okay, now this is T+1 data. We've taken it from the day before, so we can see this was a Friday, by the way. I'm sure you knew that already, but you can see the different pockets of CPI and so on and so forth. But that's an order book that's quite significantly imbalanced with a buy-side bias. So now let's look at the next trading day. The blue percentages are just showing you the difference between the agencies and the principals. it's more interesting to look at the imbalance between agency buy and sell. But the very next day, we see that the position is reversed. So the next day is actually a Sunday. Sorry, the next day is a Monday. And what we see is now that there is a bias on the sell side of the order book from agency trading. So that big buying maneuver, if you like, that momentum on Friday has pretty much disappeared, and that's the conclusion. Well, there was a lot of buying there, so now that's gone. Is that the end of the trade? Should we have joined in? Should we not join in? Has the market settled? We look at the price for that. Now, the next and related, this is the third and final data set, is about market crowding. Now, here we use an index. It's well known. It's used particularly in the economic space to measure market competition. It's called the Herfindahl-Hirschman Index. The two never met. They wrote their papers 15 years apart. I'm not quite sure why they're attributed as both. HHI is a bit of a mouthful, so I prefer to use Hirschman, who's a very interesting character, worked for the CIA. So what we've got is a statistical measure of market competition. Very simply, it's the sum of market share squared. A number from 0 to 10,000. A number of 10,000 means there's only one participant in the market. 2,500 is considered to be a competitive market. If we look at the same data for the 7th of February, and we look at the buy side of the order book, which remember was imbalanced, we're only looking at CPI here. We can see that the index registered 5668, which is a high value. We can see that the rest of the market was all around about the 2,500 mark, which, as I said, is indicative of a competitive market. So that tells you that the buy side of the order book wasn't being driven by lots and lots of players who were buying the stock. Maybe that would indicate there's a fair value move. Maybe that would be something that would indicate a permanent change in price. Actually, it was a small number of participants, possibly 2 reasonably sized ones, plus maybe 10 small ones who are participating in that trade. And we can see that by the time we get to Sunday, that's all but gone. So that buy trade is pretty much down to the 2,500 mark. And that tells you quite clearly that that trade had effectively been completed. So now, theoretically, but not perfectly, we can imagine that a biased order book with a small number of traders are pushing the stock. We can expect that not to be a fair value change. Therefore, we could expect that the stock price would revert. And there's Wally. So we can see that on the trading day, the price went up on the Friday. The trade was pretty much finished, and CPI reached a local peak. I think that was an all-time high in December. So we reached a local peak on the 7th, and then the stock reverted. So that's the trade. Now we can see very clearly from that, we see the momentum in the liquidity of the order book, and the two things that we can draw out of that is both in terms of the imbalance and in terms of the market crowding index. This is a new data set for South Africa. It's emerging. It's an emerging data set. So, for example, many of the European exchanges are now providing this. But it's a really good example, and I'll come back to that slide. I don't want to give the game away. It's a really good example of where exchanges can step in and use information that sits within the order book, and it's not just exchanges, any trading venue can do it. They can take that information and they can create dimensionality that we can then use to understand the dynamics of the market. And the examples that I'm giving you here is price forming around a competitive market, or is it a non-competitive market? And what is the momentum in terms of the order book imbalance? So these data sets are, I'd like to say, emerging because we're seeing more and more of them. We're seeing them being produced around the world, and we're seeing that exchanges and trading venues are stepping in to produce the data sets because they're helping with the process of transparency. They're helping the community, not just on the trading side, of course, but also on the investment side, to understand more about the dynamics of the market. And very interestingly, I don't really have many comments about this. This is just an observation. But what we see is that the imbalance between principal and agency trading over the period that we started gathering this data, which is January 2020, has been narrowing to a point of being around about 50%. I haven't really got too many conclusions about that. I think that's a really interesting observation, and I'd love to hear anybody's thoughts, possibly over a beer later on, because I've run out of time. So summary slides, never as interesting as the details in my view. For me, the markets are becoming ever more complex. That cluster chart that I put up, we collect over 3 billion data points a day to produce that cluster chart. All of that has to go into some form of aggregation, some form of dimensionality. The analytics that data is capable of producing are more and more powerful. We have machine learning that can help us to understand it, and we have really good ways of delivering that data to the desktop. As an industry, I think this is restoring some transparency to a highly fragmented market, and it's not just in Europe, it's not just in the US. As we see from the South African participation in that fragmentation, in that European fragmentation in particular, we need these data sets to help us understand market dynamics better. Thank you very much. It's been a real pleasure once again to come to the South Africa Connect. We'll see how this went down if I get invited back next year. In which case, maybe I'll try fewer slides next time, and then you can go to sleep. Thank you very much indeed, and I'll see you for a beer later.